Welcome everyone to this month's Zoominar. Today I'm joined by Kristin Brandli, and she's going to be sharing with us all about investing basics. This is a really important topic, and although I can educate my clients about investments, I do not give investment advice. Thankfully, Kristin does. So she's going to walk us through all of the questions that you may have about getting started, or if you've already started, what you should be doing, so that we can cover all of that for you guys. Just a few housekeeping issues before we get started. This is being recorded, so just please keep your video off for the first part of the presentation. Kristin and I are going to be going through a bit of a Q&A, and Kristin has a few slides that she's going to be sharing with us to make sure that we capture all the concepts well. And then after that, we can turn the videos on if you want, and you can pop questions in the chat so that we can get your questions answered as well. A few more things that we're going to be having coming up. Next month's Zoominar is going to be with Lisa Nicer, and we're going to be talking about taxes. I'm really excited for that, given everything that's going on with taxes this season. And if you've ever wanted to work with me but have been interested about what it would look like, I'm starting a new group program, and I will drop the link in the chat. So if you're interested in kind of working with me along with a community of other lawyers to support you in your money journey, you can check that out. And finally, I am also going to be giving a training on my own process for how I help my clients with their money management skills. That's going to be happening next week. I'll be sure to drop a link to that in the email that you get with this recording. So be on the lookout if you've ever wanted to know exactly what I do with my one-on-one clients. That'll be next week on President's Day, when maybe we get a little bit of a break. And wouldn't we all like to talk about money on President's Day? So without further ado, let me turn it over to Kristin. Oh, again, hello and welcome. For anyone who doesn't know me, I'm Jessica Medina. I'm a former lawyer turned accredited financial counselor, and I help lawyers figure out their money so they can pursue their true passions no matter the salary. But today, my special guest is Kristin Brandli, and I want to give her a chance to introduce herself to our fine audience.
Perfect. Thank you, Jessica. Thanks for having me. I'm happy to be here, and hopefully this is a relevant and informative, and also maybe hopefully a little bit of fun program for you today. Myself, Kristin Printon, as Jessica mentioned, I am a senior partner with Moxie Wealth Management. It is a kind of boutique financial planning firm that my business partner and I co-founded about 6 years ago now. And really what I do is help individuals and families essentially just make smarter money decisions, from everything from kind of developing a comprehensive plan to then the actual implementation. And so really implementation is just a fancy word of saying I can handle insurance and I can manage investments. So the investment piece is what we're going to focus on today though.
So I have just a little background question for you, Kristin, before we get into the meat of it. How did you get into this, and what interested you in pursuing, this path of becoming a wealth manager?
I joke that I was a bit of a weirdo that figured this out really early on in life. I was lucky enough to go to a high school that had both a personal finance course and an entrepreneurship course, and loved both, and basically just married the two together and came up with financial planner. I do not come from money at all. And so for me growing up, it was more, I learned what not to do. And I had seen how my parents really struggled with money. And it was a really emotional, in a bad way, kind of topic growing up. And so for me, I wanted something where I could help people. And through those classes in high school, I naturally learned I was pretty good at this. I was budgeting before I knew that that was what it was called. And so I was really just kind of combining those skills of just kind of naturally being good with the numbers and budgeting and kind of understanding those kinds of concepts and wanting to help people not make some of the same mistakes that I saw my parents make growing up. And so that's really kind of what led me to this career.
Oh gosh, yeah. The stories that we hear in terms of how you grew up with money has such a huge effect, but it can really go either way, right?
Yeah.
You could either end up great with money, or you could end up repeating the same behaviors. I talk about that with my clients all the time, and it's such an epiphany when they realize where some of the stuff has come from.
Yeah,
but
absolutely.
All right, so to the nitty gritty, Kristin, tell me, what is one of the most misunderstood aspects about investing?
I think for a lot of people, it's just simply not even understanding all the different places their money can go. I meet with a lot of people that may have cash at the bank for emergency reserves and then maybe a retirement plan through work, and that's it. and they really don't understand that there are multiple retirement accounts that they may or may not have access to, but there are also non-retirement accounts to kind of help bridge the gap between savings and maybe short-term emergency reserves and pure retirement. And so for a lot of people, it's just not even understanding what's available. So I don't know, Jessica, did you give me screen sharing capabilities?
You have the power, Kristin.
I
Show
have
us a
the
visual.
power. All right. We'll see. Perfect. All right. Can everyone see? I was like, I don't know if you're looking at my kids right now or a screen of.
I see your slide.
Okay, perfect. Okay, so this tax diversification table, this is something that I talk about with clients all the time, because very often people, when they're thinking about investing, they get really hung up on what types of security should I invest in and how aggressive should I be or not be. And while those are great topics, we tend to hear about diversification of not having all your eggs in one basket. And usually that's more meant for your actual underlying funds that you're invested in. It's also really important to make sure that you're diversified from a tax standpoint. Now, I will put my asterisks out there. I am not a CPA, like I'm not going to do your taxes, but I like walking through this with clients because it's kind of the game board in my mind for investing. So if you look at these three columns, pretty much any investment account out there will fall into one of those three categories. So it's just important to understand the differences and kind of the features amongst them. For most people, we've got access to a 401k through work. If you work for a nonprofit, you might have a 403b. If you've maybe left an employer, maybe you now have a rollover IRA, or if you're self-employed, you've got your own retirement account options as well. So those might be a SEP IRA or potentially a simple IRA if you've got employees. With any of those in this column that we're looking at, all of these, you get a deduction on the front end. So these are part of what is considered a qualified account. Anytime an account is considered qualified, that means the IRS is going to give you a specific tax advantage associated with it. But anytime the IRS is going to give you an advantage, they're also going to put a golden handcuff on it of when you can get access to the money. So for these, we get the tax deduction up front. So in the year that you contributed, that's when we get that deduction. Continues to grow tax deferred. So along the way, as you continue to have gains, you don't have to pay taxes on those, they're deferred. And then in retirement, this is then when you would take money out, it'll be treated just like you earned that money. It'll be treated as ordinary income and you'll pay full taxes on it. In this column, whether or not you have access to a Roth 401k is something dependent maybe on your company plan. But in this column, think of it almost the exact opposite as the first one we just went through. So in this space, we've got no deduction on the front end. So this is, you've already been paid, taxes been taken out, you're just paying or contributing out of just your bank account. So no deduction on the front end. Tax deferred growth still, and then a tax advantage withdrawal. And there will be a bit of an asterisk because this is more specific to the 529s because those are college related. But if we think about just maybe your Roth 401k or Roth IRA, if you're eligible, there are income restrictions on whether or not you can contribute to that. But with the Roth side of things, we get the tax advantage on the back end, meaning if you need money out, whatever that dollar amount is, we don't have to pay taxes on it. So if you need 10 grand, it's 10 grand. The non-qualified space, this is what I often see as the biggest gap for most people. Because like I mentioned, oftentimes people have savings account at the bank for emergency reserves and then retirement account. And for a lot of people, there's a lot of time in between now and when you're actually going to retire. And this is an area that people sometimes just don't even know exists. And they're looking for, if I've got enough money sitting in the bank for cash and pure emergency reserves, what's another place that I can grow it, but I'm not locked into retirement? This is a non-qualified account. So if you remember the qualified piece where we get a tax advantage, but also a golden handcuff, now we have a non-qualified piece. So not a specific tax advantage, but because of that, we've removed the handcuffs on the account. You can use this money whenever you want, however you want. It's not tied to a specific point in time of either retirement or like a 529 college. So in these accounts, and there's a lot of jargon in my industry. A non-qualified account, think of that also like an individual account or a joint account or a brokerage account. All of those are different ways of saying the same thing. In this account, you don't get a deduction for money going into it. It's tax deferred to an extent. I like to use a stock as an example, although I don't typically suggest investing directly in those. We can get into that later, but think of if you owned Best Buy and you held that for 3 years. While you're holding that stock, we're not paying taxes on it. It's up until you sell and officially recognize that gain. That's then when you would pay taxes on it. So there's a little bit of tax deferred growth, but not to the same extent as your actual qualified retirement specific accounts. The tax advantage withdrawals here simply have to do, and we'll see with the new administration if this changes at all. Lisa will be a good topic for Jessica here next month. As of right now, you would pay a capital gains tax on those. So I like to kind of use an example because oftentimes I try to coach people that you should have an investment account in every one of those columns. We should have 3. And the reason why is because it creates so much flexibility for you in retirement. So if we flash forward to retirement, say an expense comes up and you need $10,000. In the first column, this 401k, the traditional rollover IRAs, your SEP IRAs, all of these, if you need 10 grand, you're really going to have to pull out closer to maybe 17,000 just to net you that $10,000 because we have to pay full ordinary income taxes on it. Obviously, it's an estimate. I don't know exactly what your tax bill will be, but it gives you a good idea. In the Roth side, 10 grand is 10 grand. In the non-qualified space, because we're dealing with capital gains, maybe we have to take out closer to 13,000 to, again, just net you that same 10,000. So it's super helpful to have something in all 3 columns. And this non-qualified account, think of this more as your flex bucket is kind of how I like to describe it. Having this not only can act as backup to emergency reserves, it can act as kind of helping to pay for college. It could be future wedding funds for kids. It could be big trip. It could be second home and, down payment money, all the way through to eventually actually being retirement dollars. But that account gives you so much flexibility, including even early retirement, because we don't have a specific age tied to it of when you can get access.
Yes, we did. Last month, Zoominar was on fire for lawyers. So anybody who came to that knows that it's financial independence, retire early movement, and making sure that you have a way to access money before you are of retirement age, right? And can get at some of these tax advantaged accounts, and this tax advantaged money becomes so important when you want to do something really big at 40 or 45 or even 50. And understanding the flexibility of the different types of accounts, I think, is so important and is not covered by your employer, right? Because your employer only handles certain types of accounts, and that's the ones that most of us have something in. We've been forced in, perhaps, through some sort of automatic inclusion, which we are thankful for. Thank goodness that they're starting to do that. But thinking through all of the other pieces of the pie and thinking through your life in phases, not just working, not working. There's more than 2 phases to life now, and starting to think through that, I think, is so important.
Absolutely.
So Kristin, okay, great. We have a rundown of what types of accounts we might want to think about. So once we have an idea of where we're going to be investing, tell me, what do you suggest in terms of getting started?
As far as getting started, I would say for sure the sooner you can start, the better. I think a lot of times people get really hyper focused. I know, Jessica, you and I have talked a lot about debt, and people tend to get focused on, I have to get all of that completely gone before I can even start. And really, it's to your benefit. Yes, have a good emergency reserve, have a tactical game plan for paying down debt, but the sooner you can start, the better. Because and hopefully, again, I share my actual screen. This time I'm just sharing the PowerPoint, so hopefully you can see that all well. In this case, really it comes down to the sooner you start, the less money that needs to come out of your own pocket to still end up with more money in the long term. And so people tend to think about compounding interest of working against them in regards to debt, which is true, but can also work for you. And the longer amount of time you have to allow those investments to continue to grow, the better off you'll be. So this is just a quick, very kind of basic example, but I wanted to show people the differences of how dramatic of a savings kind of balance, if you will, on a monthly basis you need to contribute to get on track depending on when you start. So in this instance, we're just aiming towards $1 million. I tried to keep it kind of a nice round number by age 65. Again, assumed an 8% rate of return. That's just on average. Some years are going to be better, some years are going to be less than that. But just for this example, we're assuming an average of 8. And then if we go out until age 65, if your current age is 25 in this example, we've got 40 years left. We'd need to save about $300 a month to get on track for that. Now, if we skip ahead 10 years, now you're 35, we've got 30 years left. You can see it's a pretty dramatic jump already. We're at 680. Now, if we wait until age 45 to start contributing, we've got 20 years to save. Now we're at 1686. And obviously you can see now at 55, we only have 10 years. The bulk of reaching that $1 million is going to be on you. It's going to be coming out of your own pocket because we don't have enough time to allow all that interest to continue to compound on itself. So I always suggest, even if it's starting small, $50 here, $100 there, whatever you can do to start, the sooner off, the better off you will be. Because like I said, we can run the math all day long. The less you're going to have to save out of your own pocket. It's going to be a lot easier to reach your goal the sooner you start.
Yeah, these numbers are so powerful. And I think, especially I have some of these conversations with lawyers in particular who happen to be in a profession where they may front load their highest salary, right? Not many people go into a career where you graduate and you may make more money than you ever will for the rest of your life.
Yeah.
And that can be harder to plan for, right? Because so much of the system is set up for backloading of retirements, right? You have the catch-up funds, you have all of these benefits that are made to help people at the end of their saving journey. But if you can be really aggressive in the beginning, it's such a huge weight off your shoulders because maybe
Absolutely.
you don't have to spend 40 years saving. And that's something we talk about in the FIRE movement as well. But, I think the power of time can never be overestimated when it comes to investing. And I think so much of the conversation centers on debt. Kristin and I are here to balance the scales and make sure that our folks are thinking about both sides of their financial health and not over focusing in any particular area.
Yeah.
So of course, Kristin, I couldn't bring you on here without asking you, what are the common mistakes that people make when they're getting started investing?
I think and I'll stop sharing this now. For a lot of people, common mistakes are just waiting too long and not fully even understanding what they're trying to do and kind of how maybe a particular account may be used. I'd say the biggest thing with that is people jump in and start trying to time the market. And 2020 is a really good example of why we don't do that. It's so important to have an actual investment strategy that is tied to you and your situation. And every strategy for every actual account that you have may be different. Money that's needed for different time periods should be managed differently. So that non-qualified account that I referenced, that most likely is not going to be managed the same way as your pure actual retirement accounts, just because we have a different time horizon and we may have different goals tied to that non-qualified account. So very often people get their sights set on, I want to beat the market. And while that's an okay goal, my goal is to help you not run out of money and to have the amount of money that you need for whatever the specific goal is. If we beat the market, great. But if we are invested in a conservative growth portfolio, frankly, we shouldn't be beating the market. We're taking significantly less risk. And I think people kind of misidentify what risks they're really facing and get caught up in trying to zig when the market zags. And there is no perfect way to market time. If someone was able to do that, they'd have all the money in the world. And to do it correctly, you have to be right twice. You have to be right on exactly when to get in and when to get out, or vice versa. And it's almost impossible to be correct on both sides. So I think that's the biggest mistake, is not sticking with a strategy, and maybe getting a little emotional. When 2020 hit and March, we had a significant downturn in the market, people might get a little spooked, and it's very easy to be emotional about your own money. That's not a bad thing, but that's also part of why working with someone who's not emotional about it. It's very easy for me to not be emotional about your own money because it's not mine. So to have someone else come in that can maybe have a little clearer head and a little bit more perspective to help shine a light on, this is why we are doing what we're doing. We have the strategy in place regardless of what's going on in the marketplace right now, because we still have 20 plus years until you retire. What you're experiencing now isn't actually going to impact you 20 years from now unless we make a drastic change. So it's more important to stick with your strategy. We don't change your strategy unless your goals change. We don't make changes according to your investments, according to what's going on in the marketplace, because no one has a crystal ball.
Oh, I really feel for the folks who went through 2020 and got out in March, right? And got out at low
Yeah.
point, because
Yeah.
it was tanking and everyone was freaking out. And they got out at a low point and they didn't get back in. And now there's just all of that growth that's lost, right? All of my
Yep.
clients who looked at their retirement statements had a rough year.
Yep.
My clients who looked at their January of 2020 and their December of 2020 thought, well, just another year in the market, got
Yep,
some growth.
exactly.
All right, well
Exactly. Yeah,
done.
that first quarter was rough, ending of March. And what people don't realize too is once the market kind of bottomed out, which I think was March 23rd, the next 100 trading days were the best bull market we've ever had in the history of the market. And so it just goes to show, like, if you were wrong on any one of those particular days, the market was fluctuating like crazy, and it just wasn't, you just can't time it correctly. And so I have a few people that call just to kind of need reassurance, to say, hey, are we still good? And as long as they hear that I'm not freaking out and I'm saying, hey, we're keeping things steady, we've got a strategy for a reason, then it's all about setting expectations and just understanding why you have what you have. I think that's where people aren't able to always tie it together, because their sights are set on just the market and not on their own situation and how the money's actually meant to be used for them.
Mhm. So talk to me a little bit more about, the planning and the goals, right?
Mhm.
Something that comes up with my clients all the time. How do I prioritize all of these different goals, right? I have kids in
Yep.
daycare. I want to save in their 529. I need to save for my retirement. Maybe we'd like to get a bigger house one day. There's all of these things pulling people in 1,000 different directions. Not to mention, I want to pay down my student loans.
Yep. There's a lot of competing goals. Yeah, it's rare that people come to me and are like, hey, I've got all this excess money and I've got enough available to get on track for every single goal. So really prioritizing first and foremost, so like, what is actually the most important goal? And let's kind of set our sights towards that. And as we get on track, start making adjustments for kind of the secondary goals. But a big tip that I suggest for people is to try to make a goal of increasing every year. And it doesn't have to be huge, but that again kind of goes back to, the sooner you start, the less you have to save. If you can just get into the habit of every year, we try to do a slight increase. And I do have some numbers that maybe will help kind of showcase this as well. But if we look at just a slight increase, how big of a difference and how much of an impact that can make. And oftentimes if people are like, well, how do I find the increase? Like, how do I aim to do that? And a lot of that is just trying to take advantage of kind of what I call windows of opportunity, which is, we did get this debt paid down, and whatever that monthly payment that was going towards that, how can we just reallocate that maybe towards saving or towards investing? Or kids are out of daycare now. You were used to spending that. Now, how can we take that expense and reallocate it? And so it's trying to find these increases in what you were already used to spending and what you were already used to going out the door. How can we kind of capture those? Because very often what happens is, if you don't have a game plan already for that, it's really easy for that kind of freed up money, if you will, to just get absorbed into cash flow. And we just increase lifestyle. And that kind of hurts you in two ways, because one, you're not saving anymore, but now you're also what we need to recreate eventually in retirement. You're used to a more elevated lifestyle. So now it kind of puts an extra burden on you. If we can recapture some of that and just do a slight increase, it'll have a big difference. So this screen, and this is the last slide that I'll share today, but this just shows the difference of a slight, and when I say slight, I just mean a 1% increase, that in this particular example, both people are starting out at age 30 and we have them retiring at age 65. In this case, the level saver starts out at 5% and they stick with that all the way through from age 30 to 65. The increase saver also starts at 5%, but increases 1% a year until they hit 10%. So really it's only 1% for the next 5 years. And then they hit 10% and then they continue to stay level. So we're only talking about a 5% difference. But that additional 1% for the next 5 years ends up being obviously a pretty dramatic difference in this particular scenario. So in this case, it was looking at a $40,000 salary, again, still adjusted for inflation, still using that same 8% rate of return that we did on the last slide. But the difference between a level 5% and an increasing 5% to get you to a 10, and then we stay level, is obviously a pretty significant impact between 500,000 and 930,000. So slight increases as money becomes available, as debts get paid down, or like I said, kids get out of daycare, or maybe you do have an increase. I know with big law that tends to be kind of laid out. Maybe you do know what that step up will be, or maybe there's a bonus. Where this comes into play, maybe if you're self-employed, is just knowing what is that percentage that we can kind of try to earmark for every year. And we just uptick that by 1% every year.
Yeah, I talk with my clients a lot about the different phases of life, right?
Mhm.
Especially as lawyers, we have a tendency to be very black and white thinkers, right? We are either 100% or we are zero. If we
Yep.
can't do everything simultaneously, well, then forget it. We're not doing anything at all.
Yep.
And, I often meet with people when they are in a tough time of their lives, right? Their children are small, maybe they've just started at the firm, they're at the beginning of their student loan repayment journey, and everything seems impossible. But when you can break down, there are going to be these transition points. And
Mm-hmm.
just like you said, you're going to have a decision to make. Are you going to recapture that money and use it for your future? Or are you going to take all of it and use it for your present? And that's
Right.
a choice that I leave up to my clients. Of course, it's not my job to tell them what to do. It's just my job to show them what the consequences may be,
Exactly. Yep.
depending on
Yep.
what
I like to describe it as like the ripple effects of your decisions. It's fine if you want to keep that all for the present. Just know that that might mean delaying retirement or less money in retirement. And it comes down to like, which is the higher priority? Is it retiring earlier or with the amount of income that you want? Or is it increasing lifestyle? I'm fine with either one, but I need you to know and be informed before you make the choice.
Yeah. So tell us, Kristin, how does someone work with you? What is that like, kind of the onboarding process, and what are your favorite problems to solve for clients?
Yeah, so for people when they work with me, it's probably somewhat a little bit similar to you in kind of the onboarding process of I really just need to get to know who you are first and foremost, and what is it that you're trying to accomplish, and really help me understand the context and the rationalization that you've had for maybe some of the decisions that you've made and why money is where it's at. And then I can then, as we kind of dive deeper into goals of what specifically are you trying to accomplish? And it doesn't necessarily mean you have to know to the dollar amount and to the day when you want to retire, because oftentimes that's kind of a nebulous goal out there that we don't necessarily have a lot of concrete numbers for yet. But I can help at least get us in the ballpark to say, all right, I've run some numbers, some projections to say, here's this goal. Are we kind of in the ballpark? And now let's break it down into exactly what do we need to be doing now to get on track for that. And once we know that dollar amount and kind of know where that fits in within the budget, then it comes down to whether or not we're opening investment accounts or handling insurance or whatever that may look like. In that space, that really is a financial planning relationship. So it's an advice-based relationship. There's an actual contract that we signed that initiates a fiduciary liability on me to develop this comprehensive financial plan that we continue to update every year as we get together and kind of hone in on those numbers. From the investment side of things, the door is pretty open because I'm an independent financial planner. And that just means I don't represent any particular insurance contracts or any particular investment platforms. I've got pretty much free reign to the marketplace. So then, depending on kind of account balances, what type of an investor you are, and kind of which accounts maybe we're trying to look at opening, that will then dictate what type of investment platform that we would kind of go with. And then obviously there are kind of additional fees associated with those, and the fees just depend on which investment platform that we're working on.
So obviously, I love that you think of the whole client, because that's why you and I think so similarly on so many issues. We treat someone like a whole person through our entire relationship with them. But so just if somebody is thinking about, oh, am I at the right point in my life to reach out to Kristin, or should I be doing this on my own, or should I try out one of those robo-advisor things that I hear about all the time? Give us a sense of when is it a really good idea to call you versus, okay, maybe there is a different option that might make sense.
Yeah. For me, it's a little tough because every advisor is a little bit different. For me in particular, I think it's most important to kind of probably have your cash flow, just kind of overall budget, have that kind of under control. Because if you're running a deficit every month, like that's its own problem in and of itself, that while I am capable of solving that, frankly, it's going to be a detriment to work with someone like me because it's going to cost money to have someone like me comment on those kind of things. And I don't want that financial planning fee. Exactly. That's where you work with someone like Jessica.
It also costs
work
money
with Jessica.
Work with me, but not as much.
Yeah, what I will charge is probably going to be a detriment to that. And how I tend to work with people, it's not so much that people really graduate from kind of my services. It's much more of a long-term relationship. At least that's how I try to set that up. That in an ideal world, we can kind of get rid of this speed dating of advisors. And if you decide, hey, this is who I want to work with, that's ideally who you should work with through retirement, because that frankly is when you're going to have the most amount of questions. When it comes to robo advisors, I like to equate those to kind of the robo advisor in my industry is like legal Zoom to the legal field. You certainly can do it on your own. Will it be cheaper? Absolutely. Will it be comprehensive and tailored specifically to you? Will you understand the process? Probably not. So for a lot of people, while you can solve it cheaper by either doing it on your own and opening up your own account or going the robo-advisor account kind of side of things, it's going to come down to what do you value most. And if you're so fee conscious and that is super important to you, and you're kind of willing to not have the human component and the actual advice and someone looking over your shoulder to say, hey, how is this particular account allocated and invested? Are you rebalancing it every year? How does this fit into your entire financial plan and not just solving it in a silo? If we don't care about the plan, then by all means, kind of go do things on your own. You certainly can solve it cheaper. And I think for some people, maybe if you're just starting out, that might make sense. I tend to say once you're kind of in that 50,000 plus, if not 100,000 plus for kind of account balances, these are real dollar amounts now. So I would, obviously I'm biased, but I would advocate for a more proactive management style and making sure that it's really appropriately allocated for your specific situation. I find there's a lot of inefficiencies when people do it on their own, especially with robo-advisors. I've seen clients come to me that are flat out missing asset classes, or they've got 3 funds all doing the exact same thing, and they're paying too much just with internal expenses, and they just have no idea because it's never been clearly explained to them because there's not a human on the other side to explain it. So it's going to come down to what you value most, but I'd say if you're past that 50,000 point, for sure, if you're past the 100,000 point, I think that becomes the right time that you should be working with someone.
That's really helpful. So we are getting some questions in, and I want to make sure that I give our audience plenty of time to pick your brain, because I would just pick your brain all day. Okay.
Yeah.
So we have a good one related to retiring abroad. So what happens in terms of access to retirement funds if you're retired abroad? Is that something that you help clients with that maybe are expats and living in another country? And
Yeah, I have a couple clients, though they're actually not retired, though they are expats and they are working abroad right now. And for us, it changes the dynamic because from a liability standpoint, we can't have fiduciary-based accounts. So they have to be in commission-based accounts versus a fee-based one. And that's not typically how I prefer to work with clients. So it changes things from there, but otherwise it's really just as long as they have a US address. So in this case, they're using their parents' address. As long as they've got a US address and they still have a US bank account, we can still kind of work together. From the tax component of them taking money out and then eventually using it, that's out of my realm. Really, that's going to be a CPA that specializes more in, actual international, because then you're going to have the tax component not only from the US, but also from whatever country that they're living in. So that's a little out of my space. It certainly is possible. And I think the biggest thing is making sure you still at least have some kind of US record that will make it easier.
yeah, whenever I get questions about international financing, the first stop is always to the accountant. And
Yep,
then the next stop
CPA.
is to whatever other financial professionals might appear helpful.
Yeah.
But the taxes are such a huge deal and really are material, right? Depending
Hmm.
on what's going on with your situation.
Hmm.
But so thank you. But it's great to know that you have clients, that are in that situation, Kristin,
Hmm.
in terms of if people are interested in learning more.
Hmm.
And so, we have a question from someone who is already retired that missed the boat for investing. So, how can this person invest if they're already retired, and which investing firm might be, one that's reliable for someone in this situation?
Yeah, well, I would say you probably haven't missed the boat entirely. So there are still opportunities. It's just your choices are going to change. So investing into a non-qualified account that's never tied to your income. So if you obviously it's going to depend on what you're bringing in on a monthly basis. That if you do have extra left over and you are wanting to start investing, which I'm assuming based on the question, that's kind of what you're asking, that non-qualified account you can always start. You could also, depending on where your current assets are, I guess it's a little hard because when you say miss the boat, I don't know if that means you have nothing invested or maybe we just have a particular retirement account invested. If you do have something like a retirement account, like through an old employer plan, I will often take some of that and you can do conversions into Roth IRA. So you can still even create tax-free dollars even once you are in retirement. You can't contribute directly because you do have to have an earned income, but we can always do a conversion and income isn't tied to that. If you don't want to mess with that, I'd say a non-qualified account, you certainly can. As far as institutions of where you would go, what I have access to as an advisor is very different than what you would have access to in kind of what's considered the retail space. Obviously, people hear about Vanguard, any of those kind of companies, you can certainly kind of go and start your own. That kind of goes back to that earlier question of when do you do things on your own versus working with an advisor. Given that you're already in retirement, I think even regardless of what the account values are, I would probably work with an advisor just because there is a tax component tied to everything. And if we have, you know, if you do have retirement accounts and we're taking money out, we want to make sure we're not taking out too much because that's going to increase your taxable income, which will then make Social Security more taxable. Like everything's tied together. And so for sure, once you're in retirement, I think regardless of the account values, you should be talking with an advisor because they'll look at everything and make sure that we're not crossing any tax thresholds that you didn't need to cross.
Yeah, I'm very frank with my clients. If they want to get started on their own, I have resources that, can help them educate themselves about the markets and about different types of accounts and things like that. I don't know that there's a good resource that's,
It's
worthy
hard.
of teaching you how to handle the distribution side,
Yeah.
right? When you're starting to, take money out of those accounts and deal with all of the different tax consequences and how
Hmm.
all the pieces fit together. It really is a completely different animal from the investing and getting started. But no, that's really helpful. But so, Kristin, if somebody is interested in working with a financial advisor and they decide, oh, I don't know if Kristin is my person, I'm going to talk to this other person too, what
Yeah.
kinds of questions should they be sure to ask? You and I have talked about the different types of
Mm.
financial professionals and how
Yes.
confusing our
That's-
industry insists on making everything.
Yeah.
But what kinds of questions would you want someone to ask when they sit down with someone who they think might be like you?
Yeah, I think asking first and foremost what type of firm that they even work for, that will provide a lot of context for then their corresponding recommendations. So any financial planner, it's typically one of three different types of firms. They can work with a firm that's either owned by an insurance company, where that's going to kind of be their bread and butter. They may still be able to handle investments, but really insurance is going to be their sweet spot. They can work for a firm that's owned by an investment company. And really, again, that will be their bread and butter. They might be able to handle other things, they may not. Or they can be independent. In the independent space, they don't represent any particular manufacturers of either investments or insurance, but then it becomes very specific to that actual financial planner of how they have chosen to kind of specialize in their own practice. And within that, you'll still find independent advisors that focus just on insurance, just on investments, or just on planning. So it'll be kind of what it is you're looking for out of an advisor, but understanding how they work is probably the most important piece, just to know the context for their recommendations. I would also ask, how do they get paid? Because I think people sometimes are afraid to ask that question. And everyone knows we're not non for profits. Like, we obviously make money doing this. You just want to make sure that how we're making money is in line with you and what you're trying to accomplish. And we don't have kind of these direct conflicts of interest. And so asking that question and seeing how that advisor handles that question, I think will be really telling, because if they can't tell you or don't want to tell you, either way, that's not good, and run away. So they should be able to be very transparent on what that looks like and how they charge and in what circumstances, and be very clear about that, because transparency around fees, I think, is a very important piece to even just building trust. You just have to know where they're coming from. And I would also ask whether or not they can act as a fiduciary. Not every financial planner can or wants to. And so some of that has to do with the licensing, some of that has to do with what type of firm that they work with. So if that's something that you are interested in, you need to make sure that they actually can work in that capacity, because not everyone can. I think those three questions will kind of set a really good stage for you understanding if they're the right fit.
Yeah, I think that it's so important because there are so many different names for financial professionals. And I admit, I literally just crowdsourced my own name and what to call
Yeah.
myself on LinkedIn because I couldn't articulate what I do in a way that didn't fall into an actually regulated part of the industry.
Yeah.
But having come from the SEC and having regulated both registered investment advisors and people who are not registered investment advisors and are just kind of stockbrokers out there, working on commission, just trying to make their next buck. And
Mm-hmm.
maybe they give you a great tip, but they didn't have to. It didn't have to fit you. When you have someone like Kristin, who is actually bound by the fiduciary standard, you can sue her if she doesn't keep your
Yeah.
interests front
Yeah.
of mind. And as lawyers, that's something that's very important to us. We really just want to make sure the duties are set up appropriately so that we can
Yeah.
take action when someone messes up. And so that's the layer of protection. Not that we're super litigious, but that's part of the point.
Mm-hmm.
But so all really, really good questions to ask. And if you have a financial advisor now, if you don't know the answers to those
Mm-hmm.
questions, go back and ask. They should
Yeah.
be happy to tell you
Yep.
because you have a
Absolutely.
right to know, number one, and it may change the nature of the conversations that you have, and
Mm-hmm.
you may be shopping around for someone new. Never know. Uh, It is past 12:45. I want to be respectful of everyone on here, including Kristin, that, we scheduled this for 45 minutes. If you have to drop off, no worries, go right ahead. This is being recorded. I know I have a little bit of extra time to stay on, and I think Kristin does too. So we're going to wrap up any last minute questions that we have before we close this down. But thank you so much, Kristin, for joining us. This has been amazing. We did get another question. Is there an age limit to open a Roth account?
No, actually, you can it's very rare, although I've come across this in the last few years. Even as a parent, you can open what's called a custodial Roth on behalf of your children. So not everyone may want to do that. And we didn't get into, 529s and college investing and kind of what's maybe the right type of an account that you might consider using for just kind of college savings. But no, the ownership would certainly change in that particular event. Otherwise, I'd say it's really just age of majority, which really just means age 18, that you could start opening up accounts.
And there's no maximum limit for who can open a Roth account. I could be 88 years old and I can open a new Roth account.
You could. It just depends on how you're funding it. So again, just coming back because we mentioned Roth, you do have to have earned income in that one. You could be 88 and we could be doing conversions, and that would be totally fine. So yeah, opening an account, there aren't any issues there, regardless of being a minor or, well, I shouldn't say being a minor, but all the way from age 18 to your last day on earth. Yeah.
So it's just the contributions that,
yes, contributions might change a little bit. Yep, exactly. Yep, because even with a custodial Roth IRA, it's still going to come down to like that child earned income. Like if they're age 16 and they're minors, it's going to be based off of their earned income.
Oh, yes. I have some teenagers who are working this year. They're 17. They will be opening a Roth account this year, I'm pretty sure. Yep. Okay, another question came in. It seems like investment conversations are always based around retirement savings. What about people who are looking to build wealth sooner rather than later?
Yep. So that is really going to be focused on that non-qualified account. It's going to be, think of that as that non-retirement account. So building wealth, and really it comes down to more building accessible wealth. That is going to be that non-qualified account, because as I mentioned, that can act as not only backup to savings account, emergency reserves, but can also be medium-term goals. Or frankly, if you're doing a great job in retirement and we just don't need to be funding anymore towards that, where it's kind of our catch-all bucket, that is that non-retirement, that non-qualified investment account. That would be a great place to start.
Mm-hmm. And I think that's probably where people have the most trepidation, right? Because you really are on your own. You don't have a company or, some sort of employer sponsored group where they'll sit you down for a luncheon to walk you through some of the options, connect you with a free, agent to talk you through things. But it is such a powerful piece of the puzzle, especially when you want to do something non-traditional. And
exactly.
I know a lot of the folks in my audience do not have a traditional viewpoint of how they want to live their lives, and making sure they have all the resources available and all of this flexibility is so important.
Yep.
Okay, so last question. I'm going to make a last call for questions. You can pop them in the chat. But I always want to know, what investment advice really grinds your gears, Kristin, and just drives you nuts every time you hear it?
Oh, that's hard. I would say probably anytime you hear like a random like stock tip from some unknown person that they're like, this is the latest hot stock, that it's just so polar opposite of kind of my investment philosophy and what I think a true kind of fiduciary planner is going to do, where in my world, it always comes back to a strategy. You have a strategy. You follow it for a reason. We don't deviate from that just because we heard some hot stock. I mean, that'd be like the GameStop, situation all over again. Like, we don't do that. And I think people, frankly, don't even realize by the time you hear that something is maybe a hot stock, it was a hot stock like 6 months ago. Like, it's rare that by the time it reaches your ears that it's even still viable and would even potentially make a good choice. And I do have a handful of clients that if they're really into that kind of stuff, they have their own separate investment account that it's play money. that we don't consider real money, that we know that we're not counting on that for any of their long-term goals. So if they lose it all, fine. It didn't affect anything. And if they crush it, which usually happens on accident, if at all, then great. It was bonus money and it's just kind of treated as gravy. But that to me, I think is the biggest point, because I think people are constantly chasing their tails if they're trying to chase that new next hot stock. By the time you hear about it, it's old news. So have a strategy in mind and stick with that.
I love that. Yeah, I tell my clients, look, you can have whatever hobbies you want. If one of them is day trading, we're going to treat it just like competitive biking. You're going to have a line item for it. You can play with that money, but that's a completely separate line item from everything else that we're planning for.
Yeah, yeah,
And you can go
exactly.
talk to Kristin about how to set all of that up.
Yeah. Yeah.
Kristin, this has been so wonderful. Thank you so much for joining us. I am looking forward to investing 2.0 with you later this year, because of course we can't cover everything in one 45-minute Zoominar as much as we would love to. And Kristin has so much great information to share. And as you can tell, we have very similar worldviews. So obviously I'm just bringing people on here who I like chatting.
Yeah. Sounds good. This has been fun. Hopefully it's been helpful for everyone that was able to make it, and for everyone that will listen in after the fact. I'm always welcome to kind of field questions, so feel free to reach out if there are additional things that maybe pop up after the fact.
Yes. What is the best way to reach you, Kristin, for those who are catching the recording?
Yeah, I would say probably email is the best. You can try me on LinkedIn if we're connected and shooting me a direct message that way, but otherwise it would be email. And I don't know if you're going to give that out, Jessica,
Absolutely.
when you send out the recording. Yeah. So I would just say my work email, which I'm working on my own boundaries, but it's pretty much always up. But that'll be definitely the easiest way to get a hold of me.
Awesome. All right, everyone. Well, that was Let's Talk About Investing Basics with Kristin Printon. Be on the lookout for the recording in case you weren't able to catch this live. It'll have Kristin's contact information and information on our next Zoominar coming up in March on taxes with Lisa Neisser. So thank you, everyone, for joining. Thank you again, Kristin, for being with us. And
Absolutely.
look out for us next month.
Yeah.